Good afternoon, everyone. Time really flies, right? We are in the late November. The weather is great. It's not that cold, right? Still pretty good for outdoor activities. And I think during the winter vacation, I think you guys may travel to other countries because I think most of the COVID restrictions have lifted up, right? So if you guys have chance, it'll be great to travel to because you international students in Korea are in Korea, and now you're in Korea, so it may be better good chance to travel to Japan, uh, Russia, China, and other some Southeast Asian countries. So make the best use of the vacation.
Sir,
Good afternoon.
about the final exam, which date will it be? Have you decided?
Final exam?
Yeah,
December 8th.
8th?
Yeah.
Okay, thanks.
Mhm. I got one question. Do you guys any problems with the PDF? No, not PDF. The um the PPT form of exam.
I prefer UP, but
Any problem with
I
the?
prefer UP
Sorry,
because
I think it's okay.
it's okay. Okay, yeah. I don't know. Maybe yeah. So I didn't ask you guys for I didn't ask for you guys opinion on that. So I was just curious.
Professor, I
Yeah.
I prefer you give us like a PDF or Word format.
Sorry, Chris again.
I mean, PPT performance is really hard to calculate
Ah,
because so I think a Word or a PDF is better.
Word. So Word format is better for you
Yeah,
because of the because it makes it easier for you guys to take to calculate.
yes.
Uh, mm, oh, okay. Well, for me personally, I don't see any difference between Word form and PPT in terms of calculation. But okay, I don't know. So some may be no difference, but some may prefer Word form or other form. So. Hmm. Okay, and the one thing I have one thing I regarding the final exam. This time I'm gonna supervise your um, taking the exam. So during the entire examination, you guys should the should show yourself, okay, on the monitor. Otherwise, I'm gonna regard it as cheating. Okay, so. Yeah, so this time I'm gonna supervise. And I'm thinking of the time. Isn't it too uh, generous isn't it too generous? I mean, 1.5 hours, isn't it too long? Not long
No,
enough? No? Okay. Last time you guys felt uh okay. Not too long? Didn't feel not too long? Okay.
I think it's enough.
Is enough? Okay. Okay, so this time as well, like last time, I'm gonna give you guys 10 questions, but the actual question may be more than 10 questions because there are some sub questions for one big question. So, okay, nice to you guys. Please show yourself. Okay, it'll be nice to see you guys. Today, we are going to talk about working capital management. Before we move to this working capital management, short-term financing, let's review the previous lecture. Okay, so in the previous lecture, we talked about the dividends, right? And the cash dividend is pretty straightforward, so no problems with that. But you may feel a little bit, yeah, uncomfortable with stock dividends and the stock split. Stock dividends is instead of cash, the company distribute the stock, right, to the shareholders. So then the number of shares increases, right? So then while the stock price is the same, since the number of shares increases, then you can easily figure out that the earnings per share would decrease, right? Because in denominator is the total earnings. Earnings usually net income, right? Net income is the same whether or not the company distributed the dividends in cash or stock, right? So earnings are the same, but when the distribution is made in stock rather than cash, the number of shares increases, right? So that's why earnings per share in case of stock dividends decreases theoretically, yeah. But sometimes the prices go up after stock dividends in reality. Anyway, stock split is in terms of number of shares, you can have the shareholders may have the same impact in terms of number of shares. So if stock split means that if you have one share, then after the announcement of the stock split, the one share could be 2 or 3 or 4 or 5, depending on the stock split ratio. Okay, in case of a 3-for-1 stock split, this means that one shares could turn into 3 shares. So the biggest reason for the stock split is when the stock price is too high. So too high to be freely traded among investors, then they decide to split the stocks. So then the price is the same as before, right? Before and after stock split, but number of shares increases. So price per share, right? Price per share decreases. So because number of shares trading, floating in the stock market has increased, right? So then the investors may feel more comfortable with purchasing and selling and purchasing the stock, the blue chip stocks, such as in the past, Amazon, Alphabet, many blue chip stocks split their stocks because their performance was really brilliant. So the stock prices skyrocketed. So, so that's why they decided to split the stock. So that the liquidity of the stock has increased. So that then it boosts the stock prices. So theoretically, price per shares decreases, but after the stock split, in many cases, in reality, the price of the stock actually goes up, right? So that's the reality. But theoretically, price per share goes down. That's the basic motivation behind the stock split. Okay, let's take on this question. Trenta Corporation is deciding whether to pay out $300 in excess cash in the form of extra dividend or share repurchase. The share repurchase versus cash dividend. The current earnings are $1.5 per share. Okay, and the stock sells for $15. The stock price is $15, and the current earnings are 1.5. So earnings per share, current earnings per share, right? So $1.5. The market value balance sheet before paying out $300 is as follows, like this. So then evaluate the two alternatives in terms of effect on the price per share of stock and earnings per share and price to earnings ratio. Okay. First of all, price per share of the stock, the repurchase and cash dividends. Price per share, price per share. Repurchase. First, this is case A. This is case B. Case A. Okay, so repurchase means that the company repurchase their own shares from the stockholders, right? So in this case, they want to repurchase the shares from the shareholders, right? And then they want to pay how much? They want to pay $300. Okay. They want to pay $300. So then how many shares are they gonna? I mean, the company is gonna repurchase from the shares, repurchase from the shareholders. So we need to calculate the number of shares to be repurchased, right? So what's the current price of the stock? $15, right? $15. So then the company is gonna pay how much? $300 in total, right? In total, $300. So this is a one price per share, and this is total amount of payment for the shares to be repurchased. So if you divide it 300 by the current market price of one share, then you can have the number of shares to be repurchased, right? So 20. Right? 20. So 20 shares. So 20 shares will be repurchased, right? So price per share. So 20 shares will be to be repurchased. So then what then we need to know, right? Then what's the current number of before the repurchase? What's the total number of shares? What's the total number of shares? How can you calculate the total the before the repurchase? How can we calculate the current number of shares in the market?
We can divide the equity up by the stock, how much stock is sold for.
So can you point out numbers?
1,500 divided by 15.
So could you say again?
1,500 divided by 15.
1,200 divided by 15.
1,500 divided by 15.
15. Okay, this one, right?
Yes.
And 15. Correct. So 100 shares, right? In the market before the repurchase. So after the repurchase, $20, 20 shares we repurchase. Then after repurchase, 80 shares, number of shares, right? So then what's the price per share? Price per share is going to be total market value of equity, the same as 1,500, right? So then divide by 80. So then you have a price per share. Okay. This is the first case. And second case, still we have if the dividend is paid in cash, right? Then there will be no change in the number of shares trading in the market, right? So when it comes to price per share, in the denominator, number of shares is still 100, right? And this is correct. Is this correct? 80, 100, 1,500. Is this correct? What should
Like, we will have, if we divide the equity that is unchanged by the changed number of shares, we'll have the new price per share. It should be correct.
Where to repurchase the shares, the company paid $300, right? So after the cash payment of the cash, this equity, the $300 will be paid out to shareholders, right? So there will be no excess cash on the balance sheet, and this $300 will and the equity amount will be reduced by the amount of the repurchase, right? So this should be 1,200, right? So not 1,500, 1,200. Okay.
Why we subtract? Why would we subtract this 300 from equity? It is just excess cash. It's our assets.
Yeah, but we repurchase the shares, right? So equity, if you repurchase shares, then the shares trading in the market is reduced, right? So investors get return of their capital. So the equity capital is returned to the investors. So that's why the equity amount should be reduced by the amount of compensation paid to the investor for their shares given up. Okay.
Yes.
$1,200. And in the case of B, number of shares is the same, and the equity, the total value equity will be also reduced by 1,200. Why? Because this time retained earnings, okay, in the equity, they looks like this, okay. Stock dividend reduces this part. Stock dividend stock, okay, not the stock repurchase reduces this part. Okay, stock repurchase, not dividend. Stock repurchase reduce this part. Sometimes even could reduce this retained earnings. But in most cases, reduces the common stock, the paid-in capital, and the capital surplus will be reduced. In this case, $300 will be reduced in this. This common stock or capital surplus will be reduced by $300 in this case. Okay, if we break down the equity, it's a little bit complicated, but that's how the repurchase goes. Okay, and in case of cash dividends, retained earnings reduced by $300. So either repurchase and cash dividends, the equity section reduced by the amount of the cash paid out to the investors. Okay. So then now $12. Okay. The price per shares after cash dividend is $12. And still $15, right? In case of A. Then there's difference between A and B in terms of price per share. The difference is $3, right? So $3 actually paid out to the stockholders in terms of dividends, right? Because total dividend amount is 300 if it paid in cash, and total number of shares was 100, right? So then $3 per share was paid in cash dividend in case of B to the stockholders. So in terms of from a stockholder's perspective, right? There's no change. Price per share has reduced from 15 to 12, but the difference actually the difference of $3 was actually paid to the stockholders in dividends, right? So there's no difference in terms from a stockholders' rights perspective. Okay, so you guys need to see this this indifference between the cash dividends and the stock repurchase in terms of price per share. Okay, you guys get it? Okay. That's the price per share between repurchase and the cash dividends. And the earnings per share, a bit more straightforward, right? Earnings per share in terms of earnings, net income does not change, right? So case A, number of shares reduced to 80, right? And case B, still the same, 100. So in case A, earnings per share could increase, right? But in case B, yeah, right? And in case B, no difference, right? Okay. This is quite straightforward. Earnings per share does not change whether you take whether the company opt to repurchase shares or to pay dividends in cash, right? But the number of shares, there's a difference in number of shares because if the company repurchases shares, the number of shares reduced. So earnings per share when it comes to repurchase of shares, earnings per share increases, right? Because the number of shares reduced by 20 in case of A, repurchase. But the cash dividends, there's no impact on the number of shares. So earnings per share would be the same as before. Okay. The price earnings, price earnings in case of A, right? In case of A, the price is still $15, right? And the earnings is the same, 1.5. And case B, price reduced 12, right? $3 actually went to the shareholders as dividends, and the price per share and the earnings per share is 1.5. Okay, so case A, yeah, case A has higher price to earnings than case B. Okay.
Professor,
Mm-hmm.
we have for the price per share of if we we have 15 if we buy we purchase the stock, and we have 12 if we just pay
80.
Yeah, I didn't get why it is the same for us, like for the company.
So could you ask again?
So we have here 15, and when we calculated 1,200 divided by 100, we got 12. And you mentioned that we have 3 paid something to shareholders. So for us, it doesn't make difference. I didn't get.
That's the case B. Case B. Okay. When it comes to price per share, okay, price per share after the repurchase, after stock repurchase, the equity amount will be reduced by reduced to 1,200, right? And number of shares will be 80. So then if you divide these two, then you're gonna have $15 per share, right? And if the company pays dividends in cash, still the equity amount will be reduced by this 300. So total market value would be 1,200. But number of shares is the same as before, 100, right? So then it's gonna be $12 per share. So when it comes to the price per share, yeah, there's a difference between the two, right? Case one and case A, after repurchase, price per share is $15, and case B, price per share is $12. There's a difference of the $3. But what I'm saying is that from a stockholder perspective, the difference of $3, right, between the two, actually in the hands of stockholders, in dividends. So they have $3 in their pocket. So from a risk perspective, from a stockholder's risk perspective, there's no difference. That's what I'm saying. But in terms of a price per share, there's a difference between the two, case A and B. Okay, so $3. So if you are an investor, if you are a stockholder, but the only difference is that this repurchase and stock cash dividend could be indifferent only in case where there's no taxes, right? But if you have, but when you have the taxes on tax rate, if the tax rate is different, paid on levied on dividends versus versus on capital gain, then there may be some preference there may be preference one to the other. So especially since capital gains rate is usually lower than tax rate on dividends, so they may if you are asked to choose between the repurchase and cash dividends, when it comes to tax savings, many investors may prefer repurchase, because any difference between the redemption amounts you paid for the shares repurchased by the company is higher than your initial purchase price of the share. So the difference between the two is considered capital gain, and the capital gain is subject to lower tax rate in most cases. You guys follow me? Okay. Yana, you now you're okay? Okay. Okay, so I hope you guys tell the difference, or tell the yeah, you guys understand the conceptual difference and similarity between the two, repurchase and the cash dividends. Okay. Okay, let's take one discussion as well. It'll be discussion will be good for you guys to understand better the stock dividend. So the market value balance sheet for Briggs Manufacturing is shown here. The company has declared a 20% stock dividends. 20% stock dividends. The stock goes ex-dividend tomorrow. The chronology for stock dividend is similar to that for cash dividends. So there are 21,000 shares of stock outstanding. Stock stock outstanding means 21,000 shares are if this company was listed, then trading in the market. What will the ex-dividend price be? Okay, so basically, we need to the ex-dividend price, probably ex-dividend price per share, right? Per share. Per share. So then we need to know market value of the total equity and number of shares, right? Before and after the stock dividend. Okay. Before the dividend, stock dividends, what is the price per share? Simply speaking, this is market value of balance, right? So $650,000 divided by 21,000 shares, right? That is the price per share. Okay. But after the stock dividend, 20% stock dividend, the number of shares will increase by 20%, right? So in this case, 21,000 multiplied by 1.2, right? So 20, like this, right? This is
Should we multiply 21,000? Because like 20% stock dividend shouldn't be the percent of the price of the stock, not of the amount.
so you're asking the 20% stock dividend, this 20% should be multiplied to the stock price?
I suppose, because like if we multiply it by stock, we get like 20% more stocks, but dividends are usually like the money that we get. So we need to multiply the stock price by 20% to get 20% of the stock price as a dividend. Shouldn't we?
Oh, okay, I see. Okay, so you think that stock dividends, 20% stock dividends, 20% stock dividends means that kind of equivalent of a 20% increase in the stock price. Is that okay? That's not the case actually. The stock dividends means that okay, we have stock dividends or we have cash dividends. Okay, stock dividends, cash dividends. Cash dividends means that the company distributes cashes to the stockholders, right? The stock dividend means that they distribute stock to the stockholders. So when cash dividends is 10%, oh, okay, 20%. Okay, so 20% cash dividends means that usually they refer to earnings per share. So 20% of earnings per share will be distributed in cash dividends if they declare any cash dividend. So that is the case for cash dividends. But when it comes to stock dividends, if they declare 20% stock dividend, it means that they're gonna increase the number of stocks by 20%. So the stockholders receive additional stocks, additional shares from the company without giving up anything. That is the stock dividend. Okay.
Yes.
Okay. So number of shares increased by 20% because of 20% stock dividend. So after the stock dividend of 20% stock dividend, the number of shares will be increased to 23,200, right? This is 21,000 multiplied by 1.2. And before and after stock dividends, there's no changes in the value of market value of equity, right? Just the only difference is the number of shares. So total value of equity, total value of shares, market value, still $650,000. So this is going to be ex-dividend price. Okay. Ex-dividend price. So before ex-dividend date, it was the number of shares were 21,000, but ex-dividend number of shares 23,000. So once the after the ex-dividend of the stock, after the date ex-dividend date for the stock dividend, the stock price will go down. Okay, because of the stock dividend, number of shares increased. Okay, but in reality, sometimes the price could go up or go down. In reality, nobody knows what will happen to the stock price actually. But theoretically, the price should supposed to go down. But in reality, could be different. Okay, this is a theory. That's theoretical. And I think this question may help you guys understand a little bit better in terms of accounting treatment on the stock dividends and stock repurchase and cash dividends. Because if you do not have a very understanding on what happens to the equity section in the on the balance sheet, it may be a little bit tricky to grasp the firm understanding on what is actually happening to the equity, the stockholders, equity stockholders, depending on what kind of stock, what kind of distribution is taken by the company. Okay, so the company with the common equity account shown here has declared 10% stock dividends at a time when the market value of its stock is $48 per share. Okay, so what effects on equity accounts will the distribution of stock dividend we have? So this one, right, this equity section, if you look at the balance sheet, right, this is the asset, this is a liability, and this is the equity. So you're gonna see this in this section. So this is the varies of not varies of investor. This is for the stockholder, okay, shareholder portion. Okay, the 10% stock dividends. So we just from this question, there was no changes. we understood that there is no change in the market value of equity, right? There's no change. Then this is the equity account. This is the book value. This is book value. Why? Because here the question said this is equity accounts. There's no mention on the market value of this when it comes to this account, right? So this is a book value, because especially if you see this one, common stock, $1 par value. So the total common stock based on par value is $225,000, right? So it means that what's the number of shares issued by the company? 225,000 shares. Because on common stock, you are supposed to record par value of the stock multiplied by number of shares issued. Okay. Then what is the capital surplus? What is the capital surplus? A capital surplus is when the company issue stock, even if a par value is $1, par value is one. Even if a par value means that the base value of the stock, right? But the actual capital injection by the investors could be different from this par value. Okay, so if actual injection into the company, actual amount of capital injection to the company by the stockholders is higher than par value, the difference between actual amount invested and the par value is recorded as a capital surplus on the balance sheet. Okay.
Can you repeat?
Okay. Par value, like if you have, let's say we have certificate, stock certificate, right? So on the stock certificate, on the face of the stock certificate, let's say the value of the stock certificate, face value of stock certificate is $1. Okay, so the $1 of the stock certificate was issued to investor. This is a kind of accounting class, investor, right? And the investors, if they purchase this stock certificate just at face value, then they're gonna pay only $1, right, to the company. So then there will be no capital surplus. But when the actual issuing price, of the stock is not always same as this par value. Issuing price of stock could be higher than par value, because par value is kind of a nominal amount, just a kind of a token amount. Okay, so issuing price of the stock is usually higher than this face value of the stock certificate. So if the investors interested in purchasing this stock, they have to purchase this stock at issuing price rather than par value price. So let's assume par issuing price is $2. Okay, so then even if the par value is $1, the investor should pay $2 to the company to purchase the shares. with the par value of $1. So on the accounting, for the accounting of this difference, for the accounting for the difference, they record, they create an additional account called the capital surplus. This capital surplus is the amount, the difference between issuing price and the par value. Okay. Okay. So that's the capital surplus. And retained earnings is just the earnings the company, I mean the earnings that what the company earned from their business, right? And retained earnings means, let's say they earned $100, right? And if they do not distribute these profits to the shareholders, they retain the earnings, then the accumulated earnings retained by the company is recorded as retained earnings on the balance sheet in the equity section. Okay, so that's the retained earnings. So you guys follow me? I think it, so the what effect on equity accounts the distribution of stock dividends have? So stock dividend, actually there's no change in this equity amount itself. There's no change, but there's a change in the amount among these accounts. So let's say this total number of shares is 225,000 shares, right? Because of par value per one share is $1. So number of shares is 225,000, 225,000, right? And so then stock dividends is 10%. So 10% of this shares was distributed as stock dividends. So how many shares was distributed? 222,500, right? 2,200,500 was distributed. So then, and then in terms of value, right? We should multiply stock $48 per share, right? So 22,500 multiplied $48 per share. If you multiply these two numbers, then you have a total number of stock, total value of stock dividends, right? What's that? Yeah. Is that right? Yeah. This is the total value of the stock dividends. Then this amount comes from retained earnings. So retained earnings will be reduced by this amount. Okay, and common stock and the capital surplus should increase by this amount. So common stock will increase by plus 22,500 because the value for one share is $1, right? So minus should go to capital surplus. Okay.
Why did we subtract?
Why do we have subtract? Because this is a total value of stock dividends, right? So this total amount will be deducted from retained earnings, okay? Because when you issue stock, additional stock, then it means that this account should change, right? In accordance with the additional number of shares issued. So then how we need to allocate this $1,180,000 into common stock and capital surplus, right? And the total number of shares issued, originally issued, is 22,500, right? So when it comes to common stock, because the par value of each share is just $1. So the increased amount in common stock is 22,500, and the rest out of the rest should go to the rest from the rest out of this 1.8 million $80,000 $1,080,000 after the 22,500 should go to capital surplus. Okay, so all in all, the point is that there's no change in total equity amount, but there is some rearrangement among these accounts in the equity section. So that is the effects on equity accounts from stock dividends. Okay.
Should is it always will be that the total equity does not change?
In terms of total amounts, just the 1.8 million, $1,080,000 moved from retained earnings to common stock and capital surplus respectively, right? So just a minus and plus and plus. So these two pluses and one minus is the same. So the net effect is 0. Right. So in terms of equity amount, there's no change. So that's why there's no changes in price after stock dividends.
So will it always be this way?
In terms
in
of
all
accounting treatment? In terms of accounting treatment?
In terms of no change in price and equity, just internal changes and overall amount is the same.
We are talking about book value, okay? We are talking about book value. So this is the accounting treatment. Accounting treatment, the impact of stock dividends on the book value of the equity accounts. So in stock dividends, yeah, this is the way how the stock dividends should be accounted for in the accounted for from a book value perspective. Okay, you guys get it? No problem. Okay. I'm gonna make it very short. I'm gonna dividend policy matter. Does dividend policy matter? Yeah, this is also from MM, Bodigliani and Burton, and MM. This from these two economists. So they thought that like a capital structure, dividend policy actually doesn't matter in terms of increasing the value of the stock. So whether the company pay dividends or not, it does not have any impact on the price on the price of the shares. That is their the theory, dividend policy irrelevance theory. Dividend policy is how much of that income, how much of how much the companies pay out of net income to the stockholders. So yeah. So but this is just the case where there are no taxes and there are no imperfections in the market. So only when the market is perfectly ideal, then a dividend irrelevance policy may work. But in reality, dividend actually matters. Why? There's the clientele effect, because there are many there are some investors who prefer the dividend paying stock rather than non-dividend paying stock. For example, if you are elderly person and who live your make your living from the dividends or other retirement or pension, then the cash today is much more important than the value tomorrow, right? So pensioners or someone who prefers cash today rather than tomorrow, yeah, favor have some favors on the dividend paying shares. So sometimes the dividend paying shares has a higher value compared to the similar stocks. That's the clientele effect. Okay. So changes in stock price according to demands and goals of the shareholders. So depending on the circumstances and the purposes of shareholders, sometimes even though theoretically there should be no dividend, there's no impact on the price by the dividend policy, but in reality, the dividend policy would have impact on the price because of the clientele effect. So some investors prefer dividend paying stocks. Okay, so I'm gonna yeah, make this part very short. I hope you guys take on this question if you have time. This is a little bit tricky, but I'm gonna give you answers, yeah, on this question because it takes time.
Professor?
Yeah.
You promised us to send a lot of answers for a lot of practice questions.
Yeah.
You will
I know. Yeah, so I'm gonna deal with some questions during the last two review sessions. If I could not, then I'm gonna give you, but I will definitely give you answers to all the questions. Okay, before the exam, definitely. Okay. Okay, I think this one is also, I'm gonna skip this question. Okay, so working capital management. Working capital, what is working capital? working capital is the capital you need to for working of the company, right? So you need the capital. You need a short-term capital to run the business. In the past, we talked about a risk and return and debt. I mean, in the previous lecture, we talked about long-term financing, but it is also very critical for the company to manage the short-term capital. Short-term capital, working capital, short-term capital, working capital means that this one, the cash in terms of a current asset and current liabilities are working capital, right? On the balance sheet, right? Current asset, right? Fixed asset, as you can hear, fixed asset, long-term debt, current liability, and equity. So these two are working capital. So current asset, we have a cash. The big portion of the current asset is the cash, account receivables, and the debt. Okay. Current liability, accounts payables, and short-term debt. That's the biggest portion of the current liability. So the manager of these accounts is called the working capital management. Okay. These accounts are, yeah, really, yeah. On a daily basis, the most, I mean, the accountants and the financial managers of the company, they usually should deal with these accounts on a daily basis, yeah, to run the bit while running the business. Net working capital is current asset minus current liabilities. Okay, that is net working capital. Okay, so then why we have to run why we have to manage the working capital? Because of the cash. The cash is really important. The key in the working capital management is cash flow. Cash flow. This is the cycle of operating cycle. Yeah, operating cycle. So you're gonna have a cash either from equity or debt, right? Or if the company has been established for a long time, then some retained earnings, right? So you need the cash. So what are you gonna do with the cash? You're gonna purchase some materials. If the company is a manufacturing company, right? So you're gonna purchase raw materials using cash. So raw materials, and then you're gonna process the raw materials into finished goods, right? And then you're gonna sell this finished goods to customers. But in most cases, you sell the goods on credit, right? So then you're gonna have account receivables. Right? Account receivables is the amount due from the customers, right? And then account receivables in some letters will be paid, will be settled, will be paid back the customers, right? So this is one cycle of operation, right? In this cycle, this have Oh, okay, not this here. This is the operating cycle, entire cycle, operating cycle. Then this portion, is cash cycle. This looks a little bit confusing. I think this one is better. Yeah. So this is the whole cycle is operating cycle. Operating cycle. The part of the operating cycle, this part is called the cash cycle. Why? Why this is called the cash cycle? Because this means you have cash inflow from, if receivables is settled, then the customers, if customers to pay off the receivables, then cash inflows, cash flows into the company. So plus, right? Raw materials. So you purchase raw materials, then you have to pay to the suppliers raw materials. So this arrow means cash outflow. That's why this transaction is cash cycle. But before then, before this cash inflow, cash outflow, this is called this is inventory period. This is accounts receivable period. So non-cash, let's say non-cash cycle. This is non-cash cycle. This is a cash cycle. Okay, cash cycle. Non-cash cycle. From a business perspective, right? If you run the business, if you are the company, you would prefer more cash inflow rather than cash outflow, right? That's most companies would prefer, I think. So the key in the working capital management is reduce cash cycle, reduce the time of a cash cycle as possible as they could. Okay, so here you see okay, account payable. Once you purchase this inventory is raw material inventory. Once you purchase raw materials, then the raw material becomes inventory of the company. Then, unless you pay directly, pay for the raw materials, you should account for accounts payables on your balance sheet. Okay, so account payables becomes a liability. The current liability. Okay. And using this inventory, you process the materials using these raw materials, you process them into finished goods. And this inventory is the finished goods inventory. The finished goods is sold to the customers. So unless the customers immediately pay for the goods in cash, you are going to record, the company is going to record accounts receivables, current asset on the balance sheet. Okay, so you want to get, the company want to get this account receivable to settle as soon as possible, right? And the company wants to defer these accounts payable as long as possible, right? They want to pay later, and they want to receive earlier. This may be their hope, right? Hope for. So if account payable period is getting larger and getting longer, and the cash cycle will be shorter, right? Okay. Yeah, but just understand this graph. Just understand this graph. But then we have some ratios. We have some ratios to calculate this cycle, cash cycle and operating cycle in number of days. So as I said, the key is cash cycle. So we can express this cash cycle, operating cycle in number of days using some ratios. That is the inventory turnover, receivable turnover, and inventory period, receivable period, and the payable turnover, payable period. Operating cycle consists of 2 periods, as you can see here. Once you purchase raw material, you need to process this raw material into finished goods. So from the raw material to the finished goods, the period of the processing period from raw material to finished good is called inventory periods, maybe manufacturing period, something like that, right? So then how can you calculate the inventory period? Cost of goods sold divided by average inventory. Why? Cost of goods sold is the sales. When you make a sales, then the cost of goods sold is accounted for on the income statement, right? So that is the end of this point, inventory sold, cost of goods sold, right? And average inventory means the average inventory is the inventory that is not yet sold to the customers. Okay? Not sold to the customers. Sold to the customers. And average inventory means that from ending inventory and the beginning inventory divided by 2. Okay, so average inventory is not sold. Okay, so inventory turnover is turnover means come in and get out, right? So how well the inventory turns out to the customers. So when the inventory is sold very well, then cost of goods sold will increase, right? And the average inventory would go down, right? Okay, so that is the inventory turnover. And when it comes to the inventory turnover from on an annual basis, if you divide the 360 days by inventory turnover ratio, then you can get the number of days that inventory takes to be sold to the customers. Okay, this is a rough calculation because the inventory turnover is directly related to cost of goods sold. The same goes for receivable turnover and payable turnover. Okay. Receivable turnover, receivables directly related to the sales, but not cash sales, but credit sales, right? The same formula applied to a receivable period as well. If you divide 360 days by receivable turnover, then you can get number of days that receivables takes to be cashed in. Okay. So if you add these two periods, you have a total operating period from the purchase of raw material and to the cash collection. Okay. And cash cycle is if you deduct this accounts payable period from total operating period, then you have a cash cycle. So this is a cash outflow, right? So this whole period is cash inflow, right? Cash outflow, cash inflow. The actual cash comes at this time, right? At this moment. So if you deduct the cash outflow from this operating period, the period where you don't have the period you have not yet collected cash from account receivable, this cash cycle means the period when you need cash to operate the business. You guys understand? Okay, so that's why if the payable period is longer, then cash cycle would be shorter. That's better for the company. But the longer the cash cycle, the more financing is required, right? Because you have more time. You have the longer the cash cycle, you may have more likely to need more cash to operate the business. Okay. That is the. Actually, we in terms of working capital management, there are more things to say about, but the key is cash cycle. That's why I focused on this the calculation of the cash cycle. So next lecture, I'm gonna deal with these two questions, and yeah, the rest of the questions, and I'm gonna deal with. We're gonna talk about foreign exchange. Foreign exchange is important and a little bit complicated. So yeah, today this is all. Yeah, most of it. Yeah, more or less all. Any questions? No? Okay. So then see you next Tuesday. Okay. Thank you. Bye-bye.
Thank you, Professor. Goodbye.
Thank you.
Bye-bye.